Joining us in New York is Colin Gillis. He's a senior analyst at BGC Partners. Colin's got a hold rating on eBay and a sell on Amazon. So what's going on here, actually, Colin, and welcome to the program.
It's great to be on the program. And what we saw out of eBay, was this is a company that's clearly trying to turn itself around. There are two businesses inside of eBay. There's the classic marketplace, which is the old auction site that everyone tends to think of as eBay, and then there's PayPal. Now, PayPal is a fantastic business. It's growing 30%. Everything is going along smooth, but the auction piece of eBay is under quite a bit of pressure. It's under pressure from Amazon, and they're trying to revive that segment of the business.
Colin, I'm just putting, it seems like then they're falling between two stools. Is the model, the original business model here, broken?
So that's a great question, and that's the question that many investors are asking themselves. There's two real phenomena that's happening, and why the reason that the stock is trading down so sharply after hours, right? So the first thing is, it's just expectations out of U.S. investors as to the degree of recovery that we're going to be seeing in eBay's results. And we got a modest beat, but the guidance, particularly on earnings, came in light. Now, you have to remember, eBay gets over half of its revenue internationally, so they're negatively impacted by a stronger U.S. dollar. That's about 5 cents worth of EPS impact in 2010. And then the other piece is that they're trying to change their entire business model for the auction site so that people don't pay as much money to list items, that they're paying more money when a transaction is completed successfully on the back end. So, that's a little bit of a risk as the company is trying to turn around their marketplace. The other thing to bear in mind, though, is that eBay is still selling twice as much gross merchandise value as Amazon. They did $15 billion of commerce on their site in Q1.
All right, so $15 billion of commerce, but yet some are saying that basically eBay is a jack of all trades, master of none. You're saying hold this share still?
Well, we were actually out there, because the valuation is reasonable. They're producing cash flow. It trades 15 times our 2010 earnings, versus Amazon, which is trading 46 times. Amazon is, by far the highest multiple in the space, and we say it's priced to perfection. And the reality is that, when investors are looking at what do I pay for a company that's going to be growing, somewhere in the 10 to 15% range, and having maybe earnings per share growing a little faster, that's a reasonable multiple. So shares are roughly fairly valued in our opinion. We do have a $26 price target.
Okay, so you're saying sell Amazon.com shares, but we have Citigroup, Colin, coming out and saying that Amazon.com is actually taking away business from eBay. Do you believe that?
Well, so that's actually, it's a great question, and we're going to really see that tomorrow when we get the results. But if you drill down into eBay's numbers, right, the key metric is the amount of goods that are sold on the marketplace, and that number grew 24% on a year-over-year basis. That's actually above market rates. So we would go out and we would say, hey, actually, in the March quarter, eBay is back taking share in e-commerce. So we'll see what happens when Amazon prints their numbers tomorrow. Obviously, it's a great company, and valuation calls are difficult. But, the reality is that eBay is in a 3-year turnaround, and they're making steps, and this is Q1 of year 2. They are making some positive steps.
Okay, Colin, I'm going to get your knowledge on one more stop before I go. You're saying buy Yahoo despite those disappointing sales forecasts into the future.
So, in terms of Yahoo, again, we look at this and we say, here's a company that has, north of $10 a share in cash and semi-liquid assets with its investment in Alibaba and in Yahoo Japan, both are publicly traded companies. So the rest of the business is trading for around, $7 a share, about a 6 times EBITDA multiple. And the fact of the matter is that display advertising, which is the format most often chosen by brand advertisers, is rebounding and it's getting stronger. So Yahoo is also a turnaround play, but because of the attractive valuation that we're out there saying that is a buy. There's also an awful lot of earnings leverage that's happening at Yahoo, and we did see that happening in Q1. They more than tripled their net income.
Colin, thanks so much for joining us. Colin Gillis there from BGC Partners.